This just crashed by 57%. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Bank of America warns that what just crashed has terrifying implications for the U.S. economy. And wait till you see that the charts I put together is going to change your perception about what's really going on. Now, let's head over to Bank of America, where we picked today's story up with a headline: the tax refund tracker. Refunds are now down 57% in the first 2 weeks of tax season. And this is a huge deal because not only when you think about tax refunds, what do people do with them? They put them into savings, and that usually gives people some confidence to perhaps go out and spend. They pay off a lot of that holiday debt, or they have something that they need to take care of, a big purchase or something to put money down on, and they spend the money. But now they're dropping. It's not just the fact that they're down 57%, as you're going to see. There's a much bigger picture here of what's coming for the U.S. economy. Tax refunds down by later filing of returns, as they're saying, and this is just in the first 2 weeks. If this trend continues, well, it's going to be dangerous, as refund dollars were down 72% in week 1 and 48% in week 2. Per the IRS, this has been driven by fewer returns received, that down 19% year over year, with fewer returns containing refunds. Now, that is staggering here, because when you think about, what causes people to get refunds is simply they overwithhold, or they have a whole bunch of deductions or things they write off. And so the fact is, one thing we know for certain right now is that people are making less money. We continue to look at this chart of total compensation growth. We know that over the last year, wage growth has slowed dramatically. That's now backfeeding into refunds, and a lot of people look forward to getting them, again, to take care of some things, pay down some bills. This year not looking too good. And here we can see, and smaller average refund per person added to that. This is all partially offset by more returns processed versus this time last year. But now IRS notes that historically this is volatile in the first 2 weeks. The only question now is if this trend continues, if we see a big decline in refunds and smaller refunds, this is going to have an immediate impact on the U.S. economy. Because what are we already seeing? Further slowdown in wage growth. We're seeing those continued claims data tick a little bit higher. And what do a bunch of retailers really need right now, is particularly on the discretionary side of the economy? They need consumers to come out and spend, but without a tax refund, well, they're not going to have any money to do that. And of course, the IRS notes, along with BofA, that flat tax refunds after declines last year, and that due to inflation, the IRS has increased their tax brackets, which is nice, the standard deductions, and that's great too, and many other inputs that go into tax calculations. However, they've also noted that they've increased withholding rates, so overall refund amounts should not change meaningfully. That, of course, is if people are earning less money. Yes, it's going to change, and that is perhaps the factor here that the IRS, and nor do you see any of the political elites or the central elites talking about, is that total compensation, mainly driven by a decline in hours worked, is going to have an impact on what people take home on their tax return. And over the next few weeks may be tough for low income. Of course, this is a challenge again for the economy because low income earners tend to get hit the worst. It's not the high income earners. Yes, their wages might go down, their bonuses might be a little bit smaller, but they're not the ones that are hurting. There are people that are counting on these refunds in a bigger way, and if they don't get them, well, that means they don't spend. And this is, again, a critical time for the economy. We continue to look at all the notions around, we're looking around the world, things are slowing down. Everyone thinks the U.S. is immune to this. We're going to make the case of why that isn't going to happen at all. And this is one of the reasons, because low-income spending will slow in the coming weeks given the year-over-year refund declines from the later start to the tax fund season. This will be impactful starting next week, since each year the IRS cannot issue as many refunds with certain tax credits until the second half of February. So that gives us near-term risk for the economy. And of course, we talk about how it just sometimes takes something small or something that no one is paying attention to just to tip an economy into a further slowdown. This is definitely could be one of those. But over the next few weeks, while it may be tough income-wise, there's certainly something you can do to raise your income, and that is be a better trader. We've got all the tools for you. Let's take a kind of look at a close out of this week. We're still in this trade on our CTA Timer Pro. Now, when it comes to trading, there's one thing that matters more than anything, and that is who's moving money. That's machines, my friend. We look at how the machines are positioned in the market, but we do one thing that nobody else does, period. We run a historical overlay. When we show you extremes, it's historical extremes. There's your opportunity. When something is low, you want to take advantage. We now put this on page 1 of our reports, and I'm going to put a video up for all of our subscribers over our weekend update to go through some of the trades to help you into next week. Let's look at this. I'm back on October 9th. We noted the machines were moving up from a short position into a long position. We told our subscribers this is something you want to watch for and get in on. This was in second, backed by our Momentum Timer Pro. You know, many people have trouble trading all these technical indicators. They get in too late, they get out too early. You know, the RSI and the MACD and all these things are wonderful, but when you bring a bunch of them together and smooth it out like we do, and we add our proprietary signal overlay on top of this, we give you a much better picture. What happened on October 9th, what we know is we saw on the QQQ massive amount of technical slowdown as momentum was negative over a 1 and 3 month period. And then on October 9th, that started to change. Put a buy and open right here. You'd have to take a little downside move with it, but right now you'd be smiling, up 18.84%. So this is a great way, if you look to your trading account, to boost your income. This will help a lot. And right now, there are 3 coupon codes for a free month. Check it out. Watch that video from this weekend. We'll give you all the help you need to be more successful. But let's talk about some of these charts I put together, because you want to talk about, changing your perception of the U.S. economy. And one of those is on inflation. And everybody says inflation is going higher. The Fed says it's going higher. The political elites are worried it's going higher. And yet we continue to make the case that it is not likely to happen. And we look at these tax receipts. Now, in the big picture, what do we see? Refunds are slowing down. That's not a good sign. But what about total tax receipts? Well, my friends, that's in contraction right now. And historically, that doesn't mean there's any sign of a surge of inflation. Let's take a look at this. Let's go back now and look at federal government current tax receipts in blue against the consumer price index in red, both shown on a year-over-year rate of change. And notice as we move from the 80s into the 90s into a more globally synchronized economy, what do you see? A much stronger relationship between the consumer price index and federal government tax receipts. So as we know, during periods where the government's collecting more money, what happens is that's a sign the economy's growing. And in turn, what do you see? Consumer price index rises. What do we note? And then as we see a slowdown in tax receipts and then eventual contraction, well, that means the U.S. economy is not doing well, tends to lead that we head into a recession, and that means consumer prices come down. You'll note here, there's no indication at all, looking here, that we're seeing any signs, at least in terms of what the total government's taking in tax receipts, that would give us any indication there's going to be a resurgence of inflation. In fact, it tells us the direction for inflation is likely lower. And when we talk about supply and demand, particularly with these tax refunds, if people are getting smaller refunds or maybe not getting them at all compared to last year, well, what does that tell you? Less money to spend. That means demand goes down as supply continues to increase. That's, again, all the recipe you need to see consumer price growth come down even more. But how about the labor market? Well, that looks like it's going to get unwound as well. Here we see federal government current tax receipts against continued unemployment claims. That's shown in red. And what we can see is this just validates that when the government is seeing a negative growth in their tax receipts, it means the economy is meaningfully slowing down. We see that now. It's in contraction. In fact, every time you see a contraction of that, what happens? Continued claims start to rise, and then they accelerate higher and higher, because what happens here is all that spending from work that doesn't happen anymore because people are making less money on unemployment feeds back into the government tax receipts. Of course, we know the government's just going to run bigger and bigger deficits, choke out the private side of the economy is what they do when they run these massive deficits. It's not a good sign. It tells us that the labor market that everyone's hoping is going to hold together, well, if tax receipts continue to stay negative, Not a chance. And here we go even forward. What does this mean for the bond market? Well, you can look at this as, again, a sign that when the economy is growing, we can see that in tax receipts. It's hard to, some people just find this hard to believe. There's so much information you can glean from what's going on just from the federal government tax receipts. It's quite impressive here. And what we can note is there are periods when tax receipts are rising, and that would, again, mean that the labor market is expanding, the U.S. economy is expanding. And what do you see with a lag? Interest rates go up. And so you see 10-year treasury yields in red, and I marked a number of points where you see the year-over-year rate of change in tax receipts rise, and inflation or 10-year treasury yields head higher, which makes perfect sense because that means the economy can handle higher and higher rates. It's how the bond market actually works. But look at this time. Here we see a contraction in tax receipts. And this time we're seeing the market believe that rates go higher. Historically, well, if you look back, it tells us rates need to be crumbling down in a big way, or this means the bond market is having a decisive impact on the U.S. economy. As we've noted, the central elites have inverted the yield curves and money curves by driving short-term rates up. This is a wrong move at the wrong time, and the federal government is seeing that. And if that data remains true as it is, well, it tells us something much worse for the U.S. economy is coming, that we're not an island, we're not immune to what's going around the world, and any hopes, wait till you see this next slide, the U.S. equity market continues to rally. Well, look at this relationship here. Now we're going to put federal government tax receipts just as they are in billions of dollars, no year-over-year rate change, and overlay the Wilshire 5000 price index. You can see this very clearly. Right now, the government tax receipts look like they're headed down and probably going to go lower. And what do we see? Everyone's saying the market needs to go higher. Historically, tax receipts are giving us the strongest indication of what's really going on in the U.S. economy, not the equity market here. So as everyone plans for a big bull market, well, maybe their hopes will be dashed. Luckily, we give you the tools and everything you need to know. How to use stop losses, how to trade our reports. We give you everything you need to avoid those big drawdowns in your accounts. But let's take a look at this now from the consumer perspective, because what we see is sentiment increases now for the third straight month. But will it last? See, that's the thing. That is a big question. Everyone's coming out of this holiday fourth quarter season. They saw lost spending. There's some optimism. Yes, the labor market's trimming a few jobs. No one seems to be worried about that because inflation is coming down and the equity markets are up, and this is giving people hope. But what's really problem here is what's going on with the federal government. As they continue to collect less and less tax revenue, it's telling us the economy is going the wrong direction. And will sentiment stay up? Well, probably not. Here we can see the sentiment index edged up 0.6 points to 79.6, the highest since July of 2021. Now we got to go back a few years to see that, as this preliminary reading from February of the University of Michigan Sentiment Survey says. And here we can see consumers expect prices, this is inflation, will climb an annual rate of 3% over the next year. Well, that's not likely. Up from 2.9% expected in January, but close to levels seen in early 2021. They see costs rising 3% over the next 5 to 10 years as consumers believe inflation is baked in. But we showed you, if you look at the relationship between the consumer price index and, of course, current federal tax receipts, which are in contraction, it tells us the notion that we're going to see high rates of inflation, or even at 3%, which isn't terribly too high over the long run, is highly unlikely. The base case, what you see of tax receipts, we're heading to a recession. In that case, you don't get inflation. Of course, that means demand goes down. And while prices remain high, Americans are taking solace in the fact that inflation has largely been cooling, which is true. That combined with a labor market that continues to support resilient consumer spending, well, we'll see. Got a slide on that for you, too. We'll see how long that lasts. Is contributing to the recent improvement in sentiment. Because one thing that helps drive spending, the tax refunds. And so if tax refunds are getting smaller, going away for many Americans, well, it doesn't indicate that there's going to be this big push in the first quarter as tax receipts come in and people go out and they love to spend those. In most cases, they get spent pretty quick, whether it's pay down debt or go buy some new stuff. Consumers continue to express confidence that the slowdown in inflation and strength in labor markets would continue. Well, that's not going to happen at all. Let's take a look at this University of Michigan consumer sentiment. Now, this doesn't have the preliminary data in it because the federal government does not utilize that in their charts. But let's look at this against the consumer price index, because the key point here that I want to make is that when inflation first comes down, consumers get happy about it. They think, okay, this is it. This is that soft landing, or maybe the no landing scenario where finally I get ahead. And then, of course, their tax refund comes in and they get really excited. But this year, their excitement is not going to be as big. We know, of course, tax refund is likely to be smaller here. But let's take a look at the initial shock to the consumer view is that, yes, as inflation comes down, well, they get really excited because they're really depressed when inflation was going up and their wages weren't keeping pace. And we see that relationship over and over. So right now, it makes perfect sense. The consumers see the labor market holding up. They see inflation coming down. They're getting excited about their tax refund, and that gives them some optimism. But hang tight, because what changes that is eventually as people continue to lose their jobs and stay on unemployment, what happens is that euphoria that caused that initial increase in continued claims, well, it causes that optimism to come right back down as claims continue to go higher and stay elevated. And we see that effect every single time. And right now we're watching this because if continued claims head higher, and we talked about this on the Thursday show, it looks like they will, because as more people get on unemployment, their spending goes down and that back feeds into the economy. And eventually all these large corporate layoffs, as you see people they don't hit the unemployment line right away because they usually have a severance. Well, if that runs out and their spending dries up and they can't find another job, their spending goes down. And then, of course, eventually consumer confidence goes plummeting with it. And of course, we can even look at this against federal government current tax receipts, which suggest a very nice relationship between consumer sentiment and tax receipts. That's shown in blue. And tax receipts shown in red. And what do we note here? That consumers are getting excited, and really that's going to turn the other way as tax refunds shrink and perhaps for many go away altogether. And then you start looking back at the bigger picture of the economy, and you see this robust labor market. Well, Nike just announced they're going to have 2% of employees, which is more than 1,500 jobs during broad restructuring. He said, well, that's not a whole lot. But the issue is when you see more and more companies, a few hundred here, a couple thousand there, 10% of the workforce, it all starts to add up into the economy, because when people lose their jobs, particularly these high-paying jobs, and they get a severance, their initial spending doesn't change a whole lot. It's when they can't find a job that everything starts to change. And in this market, with continued claims staying near 2 million, well, it suggests there just aren't a whole lot of jobs out there, and people are going to cut their spending, particularly when they don't get that big tax refund. And Nike said the layoffs will take place in 2 phases. They'll start the first rounds this week and finish the second by the end of its fiscal fourth quarter, which is around the end of May. And cuts in Nike's region will be on a different timeline in the emerging market space. That depends on local laws. And it's not clear, they said, which departments will experience the layoffs, but they said it will not affect retail employees or warehouse workers, so lower wage employees. And that's a big issue here. You talk about, putting some high paid people on the unemployment line or just kick them out with a severance. Watch their spending go down. They're going to be waiting for these tax refunds. They're going to go file, and they're going to be highly disappointed based on what we're seeing, at least in the first 2 weeks so far. And these cuts come as consumers who are cautious in their spending, and retail industry braces for a demand slowdown for discretionary items such as clothes and shoes, which is Nike's bread and butter. So here we even see Nike suggesting there's going to be a further slowdown. That means higher unemployment, lower tax receipts, less demand, less inflation. And here it is. You see it in the relationship. I said about, how does this link to retail sales? Well, there's a reason we're talking about Nike. It's not just Nike that's going to be laying out. It's going to be a bunch of people. You look at federal government current tax receipts now back on a year-over-year rate of change against advanced retail sales. You can see where tax receipts go, retail sales fall. That's not a good sign for other employers like Nike, nor is it a good sign for the global economy. Is charting the global economy. Here we see UK, Japan fell into recession at the end of 2023, and everyone really believes now the U.S. kind of is decoupled from everyone, and it's convenient. When everyone wants the U.S. to be coupled to everyone else in the world because it's a good thing, then we are. But right now, the rest of the world is sliding into recession. No one wants to believe the U.S. can get there, and I'm showing you based on the tax receipts, it says we're already headed in that path. We're now just a matter of time before the data catches up to it. And the UK slipped into a mild recession in the second half of 2023, and while the economy still grew at 0.1% across the year as a whole, it was the slowest annual expansion the UK has seen since 2009. How about the euro area? They're entering in 2024 on weaker footing than previously expected. Gross domestic product in the bloc will accelerate slightly to 0.8% this year after 0.5% in 2023. Those are not exciting numbers. And how about Japan? They unexpectedly slipped into a recession after shrinking for second quarter due to anemic, here we go, domestic demand, prompting some central bank watchers to push back bets on when the nation's negative interest rate policy will end. Keep in mind, they're ending a recession during negative interest rates, and people say we can't see that here in the U.S. Just wait till we get back to zero and it has no impact on the U.S. or global economy. That's going to happen because where tax receipts go, the U.S. economy falls. Look at this chart here, and this is kind of sums everything up. You have federal government tax receipts in blue against real gross domestic product in red, both on a year-over-year rate of change. And while everybody, including the Biden administration, is celebrating the big surge in the fourth quarter in real GDP, well, hang tight. If tax receipts are any indication, that too is going to come crashing down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.